Hey guys, what's up? Alec back with the daily stock market, and look at that. Tesla below $800 once again, down 5% on the day Friday. We're also going to talk about two other electric vehicle stocks, EV stocks, so make sure you stay throughout the entire video. So make sure you stop what you're doing right now. Before we go any further, smash a thumbs up on this video if you appreciate these videos, and let's dive right into it. So first up, let's talk about what's going on with Tesla. We see them 7% down on the week, 12% down on the month, and down 20% in the past 3 months. We've seen them as high as almost $1,200 earlier this year, not even that long ago, and they did peak above $1,200 earlier or later last year. Okay, they're on a downward momentum and trajectory right now. You can see my holdings is down $164, which isn't the biggest deal because they're not one of my biggest position. My average cost is around $1,000 per share, but I'm looking to load up mainly around $650 per share or lower. Okay, so we also see some spikes that it's had in the past was $762. So if we can get to that 750, 650, I think that's a good price point to be buying at for long term. Okay, now you can see it's only 1% of my portfolio diversity. I want to get that up closer to 4% or maybe even a little bit higher. You can see I had a reoccurring buy on Tesla for $20 per day. It's paused right now, but I'm going to reinvigorate that once again. And you could also see it as a PE ratio of 162, which is implying that it's super overvalued right now. It's one of the largest PE ratios that you can find. And the 52-week high, 52-week low, we are getting closer to that 52-week low. So again, I want to see them closer to $650 per share to be loading up on Tesla for long term. We also saw them close to a $1 trillion market cap, and I believe they did break that $1 trillion market cap in the past, and right now they're at $800 billion market cap, so I do want to see that a little bit lower. Okay, so here we'll see a summary on Tesla. Tesla stock is disconnected from the rest of the auto sector, so a lot of people try to compare them against Ford Motors, which is difficult to do because, you know, they're an electric vehicle company, but they're much more than that. They're also like a tech company. They're also valued as a tech company, which we'll dive into a little bit more. The current metals price surge versus ICE, which is internal combustion engine substitute for electric vehicles over simplistic. Consumer dynamics and macro factors need to be analyzed in addition. China's expansion add more consistency to Tesla's top line, leading to an overvalued stock. CapEx versus income cash flow are superb. Risks: Tesla will need to start hedging its input costs in the future. So here we'll show a chart actually showing the price increase of Tesla, Ford, Toyota, and Volkswagen. And you can see Tesla is on a pedestal compared to the other ones that are pretty consistent with each other. You'll also see recent growth efficiency. I was pretty surprised when I stumbled upon these metrics. I've analyzed business segments for a few large enterprises in my career, and we usually look at the segment revenue and cash flow relative to CapEx. And looking at expansion, you can also see it's also clear that Tesla's management has anticipated an increase in demand with a surge in finished goods. You usually want to look at an entire pipeline of raw materials, work in progress, and finished goods and look for an alignment when determining demand. This is obviously an internal way of looking at it, but it does provide substance. And here you can actually see some of those data points. Lastly, for this section, I would like to provide an overview of the firm's expansion in China. Although Tesla's China sales dipped by 5.6% month over month for February, it still produced a year-over-year growth of 200% in China. So that's going to be a huge dominating market for Tesla, suggesting that it's penetrating a robust consumer market with a vengeance. It's critical for a firm to expand globally. Let's continue on to commodity price analysis. Much has been made for the surge in commodity prices and how it would impact Tesla stock. Although it would have an impact on the firm's variable cost, I don't think it would have a massive impact on the stock's price. Historically speaking, Tesla investors haven't flinched much whenever metals and mineral prices have increased. In fact, there's been a positive correlation. Why could this be? Well, the stock market is forward-looking and is likely separating Tesla's hyper-growth model from transitory/very elastic inflation. Don't get me wrong, I believe that rising metal prices all have massive impact on many automotive stocks, but Tesla best in class status could prevent it from being correlated with other automotive stocks. All right, first of all, the purchasing power of consumers has decreased significantly during the past year, suggesting that we'll likely experience a decrease in demand for industrial and precious metals in the short run, and they're directly related to broad-based consumer spending. To contextualize, you're only going to produce items at a rate that you're expected consumers to purchase it unless you're in a niche market like Tesla. Secondly, we're seeing less stringent COVID policies. Reopening will likely allow for capacity of metals producers to increase, likely contributing to headwinds. All right, so watch that. If you look at COVID numbers, by the way, new cases of COVID have fallen 95% from highs. We're only around 10,000 new cases per day. So if we keep this moving forward for the next 6 months to 12 months, it's going to have huge headwinds for the supply demand constraints and restrictions. So the valuation of Tesla, many look at Tesla's price to earnings and its other price multiples and conclude that Tesla's overvalued, but that's overly simplistic way of going about it. First of all, let's justify the firm's PE ratio. So here you see the PE ratio is 123, which we already went over. Yes, Tesla's PE ratio is outrageous, but if we look at the PE ratio relative to its earnings growth, which is the PEG ratio, you'll actually see that it's an undervalued metric. The PEG ratio has a value threshold of 1.0, and in Tesla's case suggests that its earnings growth is currently outpacing its stock growth by approximately 3.8 times, leaving plenty of scope for investors to capture value. The second argument concerns an asset-based valuation, which provides us with a fair value of $863. This in itself suggests that the stock is undervalued based on past results, never mind its future growth. If you see a stock trading at its current net asset value, you know it's priced by the market and trading rationally. However, Tesla is undervalued. So here you actually see the enterprise, the EV, which is Tesla's market cap. Okay, then you'll see the cash. Okay, debt market value, 8 billion, shares outstanding, 1 million. So this formula, the risks explained, although it's argued that rising commodity prices won't bear a massive effect on Tesla stock, it's necessary to discuss the risks attached. I'm going to skip the obvious of raising variable costs. I'm going to touch on hedging activities. To our knowledge, Tesla isn't hedged against commodity prices, and this is a bit of a rookie error. As a manufacturer, you always want to be hedged against input costs. I don't know if Tesla has initiated hedges since its releasing 10K report in February. However, they didn't come. If they didn't come, it could be dampening on the firm's financial management efficiency. Furthermore, from a stock's vantage point, Tesla holds a worse shape ratio than it did last year. The shape ratio is a function of expected return relative to overall market volatility. All right, so some final words with Tesla. Stock has a history of fending off rising input costs. The company has produced robust growth in an efficient manner during the last year, which also held rising prices. Its expansion to China bodes well, considering that it's less reliant on single economy. The stock is also still undervalued, contrary to popular opinion for the reasons that we went over. So you guys know my opinion where I want to buy on Tesla. Some analyst opinion, you'll see they have 34% upside in the next 12 months, around $1,000 per share. Okay, some even five-star analysts have $1,300, $1,400 per share in the next 12 months. I want to buy closer to 650 and sell some above 1,250. So that way I can get approximately a 75 to 100% return on Tesla. The next most popular electric vehicle stock is going to be Rivian, down 7% just on Friday. Okay, they're down to $38 per share. A lot of people thought they weren't going to see it. And you can see in the past week, they're down 20%, which is absolutely devastating, down 37% in the past month. And they're down 67% in the past 3 months. This is one I've been talking about to stay away from ever since they IPO'd, now down 77% overall. But look at the volume, 42 million. So they're actually more popular of a stock than Tesla, believe it or not. And a lot of people are probably just shorting them. A lot of people are probably buying them for long term. You can see that their 52-week high is almost $180 per share, with that 52-week low being closer to $37 per share. Pretty much at an all-time low right now. You can scoop up some Rivian's shares for. Let's kind of dive in a little bit deeper to see if that is a good idea, even for a long-term case. Okay, so diving a little bit deeper into Rivian, you'll see the summary. Rivian trimmed its production target for 2022 by half. So that's why they fell so significantly. Supply chain woes and higher costs are short-term headwinds only. The stock is a bargain due to its strong balance sheet. Okay, so it might be a little bit more of a value kind of play. Rivian stock saw stock price fall after earnings were released, owing to an unexpected reduction in this year's production target. Rivian is also dealing with rising costs and supply chain issues, okay, which are affecting its production forecast. Reduced production target is only temporarily stumbling block that Rivian Automotive will be able to overcome. I recommend that investors concentrate solely on Rivian Automotive long-term potential in the electric vehicle market and its high cash to market capitalization on the ratio. Okay, Rivian trimmed its production outlook for 2022. Just a few days ago, I argued that Rivian Automotive should be valued based on the long-term sales potential in the market lineup for electric vehicles, specifically trucks, SUV, and commercial delivery vehicle and vans, rather than earnings per share. Unfortunately, Rivian Automotive cut its production guidance for 2022 yesterday due to the supply chain issues that are affecting component sourcing in a timely manner. Rivian Automotive expects to produce 25,000 electric vehicles this year across its R1 and RCV platforms, with a total production capacity of 50,000 vehicles in 2022. R1T trucks, R1 SUVs, and EDV 700 commercial delivery vans are among the vehicles targeted for production. Rivian Automotive has produced a total of only 2,425 electric vehicles in history, okay, which is pretty concerning. The company also produced 1,400 electric vehicles in 2022 up until March 8th, and plans to significantly increase production in the coming years. Rivian Automotive expects to spend $2.6 million on capital expenditures this year, which might actually be $2.6 billion. I don't know how the author actually wrote that. It looks a little bit odd, but keep in mind it might be 2.6 billion in that case. Okay, all of which go towards increasing production capacity. The forecast assumes the increasing in capital expenditures begin in 2021, resulting in 1.7 billion in infrastructure investments. Rivian Automotive expects supply chain constraints severely limit production this year, despite the fact that the electric vehicle company specifically stated that its production delivery capacity in 2022 was 50,000 electric vehicles in 2022. This decreased production outlook, which is especially important for electric vehicles that are lacking earnings. Okay, so because they're lacking earnings, if they cut their guidance, which because they're not already delivering any vehicles, they're not earning any money, and then now they're also saying, oh, in the future we're not going to be delivering as much as we thought either, sends Rivian Automotive stock into a tailspin. We'll go on to see Rivian Automotive stock fell as much as 12% on Friday, but recovered some of its losses later in the day. However, the stock finishes 6% lower. Rivian's now trading 47% its IPO price of $78 and set a new 52-week low, aka an all-time low just on yesterday, which was Friday. Okay, pre-order update. In December, Rivian Automotive received 71,000 pre-orders for its R1 models. In its shareholder letter yesterday, the company provided an update on its pre-order status, stating that Rivian Automotive just added 12,000 new pre-orders in the last 3 months, which is good news. Rivian Automotive had 83,000 R1 pre-orders from the US and Canada markets as of March 8th. R1 pre-orders include R1T trucks and R1 SUV reserves. High level of cash limits risk. With nearly half of Rivian's automotive market valuation locked up in cash, the stock's risk at this point are extremely low. Even though the operational headwinds should not be overlooked, yes, inflation and supply chains issues are affecting Rivian stock's production forecast this year, but these are likely to have short-term impacts and not change the company's long-term prospects in the electric vehicle industry. Pre-orders continue to be strong, and interest in Rivian's automotive models are growing. Real quick, I want to go over this, and then we'll go over the conclusion. The ultimate value play in the electric vehicle industry, Rivian Automotive received $13 billion in net proceeds from its fourth quarter IPO, and the electric vehicle company ended the year with $18 billion in cash and cash equivalents. Rivian Automotive currently has a market cap of $37 billion, implying the cash and cash equivalents account for roughly half of the company's market value, which is actually totally insane to think about. And that is one thing that Rivian absolutely has going for them right now, is they pretty much a safe stock, a value stock, because there's not much risk of them not paying off their debts in the next few years if half of their market cap is in just cash, and they have $13 billion in cash and cash equivalents right now on their balance sheet. This is an extremely high margin of safety for investors, and it's virtually unheard of in the electric vehicle industry. Okay, now going to the conclusion, the reduced production forecast for 22 was unexpected, but it's not a major issue. Production and delivery will simply be pushed a little further into the future. Investors should also keep in mind that Rivian Automotive can produce twice as many electric vehicles in 2022 as it's projected in its production forecast. So if the supply chains works for the better later this year, and we have headwinds with the supply chains, and COVID, is not such a big deal anymore, which it's starting to look like, the electric vehicle company could scale much faster than the current anticipated, because they already cut their expectations in half. So if they over deliver, that could bring the stock price back up. Looking at the analyst forecast, they're all over the place, just like, for most electric vehicles. Analysts can't really agree too much, but overall, on average, we have 100% upside in the next 12 months for Rivian, around $76 per share, especially if they do better than expected. A lot of five-star analysts are coming in and giving Rivian 60, 130, 85, $78 price points in the next 12 months, and they all reiterated this just 3 days ago too. So it's something to consider. Personally, I'm not buying Rivian yet, but if they get much lower, under $30, under $25, I'll probably consider starting to make a position. However, it probably won't be too large of a position. Probably keep it around, 2% of my portfolio or less than that. But if they get to $25 range, it's going to be a super attractive risk versus reward ratio. Even if they are a little bit riskier and it takes a little bit longer for them to hit their goals, maybe I'll put it in my 2-year, 3-year, 4-year portfolio and just set it and forget it for a few years and watch the gains roll in for Rivian. And the last stock of today that we'll wrap the video up with is Lucid Group, LCID. You guys all know them, and you all might not love them. And I'll try to go quick on this one just to wrap the video up and we don't make it too long. But we see that they're down in the past month 17%. This is a good swing trade and option trade, because you can see there's a lot of peaks and valleys, down 13%, going up 20%. Once it goes up 20%, it drops 20%, and then goes up another 11%. So if you're an option trader, it could be a good one to look into. Overall, we're seeing a downward pattern in Lucid right now, and we saw them as high as $50, $60 per share in the past. For a long time, they were floating around the price they're at now, that $20 mark, $25 mark, and even been as low as $17 in the past. And remember, they did IPO around $10 per share. I have a very small position, obviously not even worth noting. Looking to expand my position a little bit more. So let's kind of dive a little bit deeper, other than a $37 billion market cap, which is right towards the size of Rivian. So if you want to do something on your own time, you can look at their revenue and the net income and compare Lucid to Rivian. Obviously, Rivian's going to be hard to look at those numbers because they haven't been producing any revenue or net income yet. But in the next 1 to 2 years, these will be two great stocks to continue to compare against each other over the next 2 years. Okay, for a quick summary investment thesis on Lucid, you'll see the stock has dropped more than 60% from its November's highs. It's weaker than expected production guidance for fiscal year 2022 has impacted the stock post-earnings. We discussed why Lucid's ability to ramp production is fundamental to its outlook. Nevertheless, Lucid stock remains a buy. Investment thesis, Lucid reported its fiscal quarter 4 results recently, which disappointed the streets and investors. The market focused on its marked reduction in 22 production guidance to 12K to 14K. The guidance was revised downward from 20,000 previously, but we have also highlighted in a previous article that Lucid investors need to stay patient for the company. It's all about the medium-term capacity ramp that's critical. The revised production guidance was mainly attributed to the supply chain engulf global companies worldwide. However, Lucid is not facing the critical chip shortage that have bested the legacy automakers. Therefore, we're confident that the company can overcome these near-term challenges moving forward. Notably, its order to book 25,000 grew 47% in November, update of 17K. So that, as the question is, Lucid stock buy, sell, or hold. Lucid stock is remaining at an EV forward value 23, revenue 9 times. Nonetheless, it's still higher than Tesla. All right, their revenue multiple is 8 times, hence why the decline in Tesla stock also impacts Lucid's valuation. Nonetheless, we think the recent sell-off in Lucid stock is overdone. Too much negativity may have been priced in its weaker than expected guidance. These are short-term results, short-term issues that Lucid should resolve throughout the year. As a result, we think that the stock could be re-rated when management guides for a better than expected cadence for fiscal year 2023. Well, this is mainly a super long-term hold. The price right now is $22. Personally, I want to be buying in like that $17, $18 range. Maybe beef up my position a little bit more then. Analysts are extremely split. We have some analysts saying as low as 12, some as high as 60. But the consensus, the average overall, the analysts have a $38 price target on Lucid over the next 12 months, which presents a 65% upside. And we have one 5-star analyst coming from Morgan Stanley, reiterated 11 days ago, with a $12 price point. All right, so it would be interesting to dive in and see exactly what he thinks is going on with Lucid. You see John Murphy, Bank of America, reiterated 13 days ago with a $60 price point. And you can see there's not many other analysts taking a look at Lucid right now, only 6 analysts total. Overall, they present a lot of risk, so it's better just to be patient on them, especially if you're going to be holding for long term anyway. If you can scoop up at that $17 price range or even below $15, I think that could be a good idea if you plan on holding for 2, 3, 4 years or more. And typically when you're investing in electric vehicles, you want to hold for long term. If you got to the very end of this video, make sure you leave a thumbs up, comment below for all the information and effort I put into these videos. For me, it's the least you guys can do. This gives me great motivation when you guys like these videos and comment below. I'm going to be replying to all the comments, of course. And if you guys want to join the close friends list, let me know, because I am doing a big discount right now at this point of the year. Message me and say you found me from YouTube, and I'll give you that big discount, the same discount that we were doing for Black Friday. So message me on Instagram, and I'll be more than happy to extend that discount for the close friends list. Now is definitely the time that you want to be buying stocks and starting some long-term positions. If you haven't watched this Warren Buffett quote on my Instagram page yet, go ahead and read through this and also listen to what Warren Buffett has to say, because I think it can help your mindset, especially if you are a long-term investor. Don't forget to share with a friend, smash the like button. I'll see you guys in the next video. Remember, don't time the market, buy the market. Peace.